A payout can change dramatically depending on one phrase in the policy: replacement cost or actual cash value. In real life, replacement cost aims to pay the cost to replace an item with a new similar one, while actual cash value subtracts depreciation. One ordinary version is a 5-year-old sofa destroyed by water damage being valued very differently under the two methods. The practical lesson is that the same loss can produce two very different checks. Replacement cost focuses on what it costs to buy today. Under the surface, prices for materials, labor, and similar items at claim time matter more than what you originally paid. Think of a roof installed 10 years ago costing much more to replace now because labor and materials rose. The viewer should remember that replacement cost protects purchasing power better. Actual cash value focuses on today's used value. The practical engine is simple. The insurer starts with replacement cost and reduces it for age, wear, condition, or useful life already consumed. Picture a laptop bought for $1,500 3 years ago receiving a much lower ACV payment after theft. Once you see that, depreciation is the central difference. People often misunderstand depreciation. Mechanically, it is not an insult to the item. It is the insurer's estimate of value already used up. This shows up when a carpet that looks fine to the owner but is halfway through its expected life in claim calculation. That small detail changes the decision because personal attachment does not control claim math. Home claims can involve two-step payments. The process works because some replacement cost policies first pay actual cash value, then release recoverable depreciation after repairs or replacement. You can see it when a homeowner receiving an initial roof payment and a second amount after submitting contractor invoices. This matters because the full benefit may require completing the work. Not everything may qualify for replacement cost. The hidden lever is that certain items, older roofs, vacant homes, or special property may have different valuation rules. For example, a policy treating electronics differently from building materials. So the useful takeaway is that the valuation section must be read item by item. Actual cash value usually lowers premiums. The moving part is this: because the insurer expects to pay less after depreciation, the policy can cost less upfront. A simple example is a landlord choosing ACV on an older rental property to reduce annual cost. The result is that cheap coverage may mean accepting a smaller claim payment. Replacement cost can still have limits. What changes the outcome is that the insurer may pay only up to the policy limit even if replacement costs rise. A realistic case is a house insured for too little during a construction cost spike. That is why replacement cost is not unlimited cost. Inflation makes this issue sharper. In real life, if prices rise, yesterday's coverage amount may not rebuild today's damage. One ordinary version is kitchen cabinets costing more this year than when the policy was purchased. The practical lesson is that coverage needs periodic review. Receipts and proof help both methods. Under the surface, documentation shows what existed, its quality, and sometimes its age. Think of photos of furniture and purchase records making a contents claim easier after a fire. The viewer should remember that evidence supports valuation. Condition can influence actual cash value. The practical engine is simple. Two items of the same age may not be valued alike if one was heavily worn and one maintained well. Picture two refrigerators, one damaged and one clean, being assessed differently. Once you see that, maintenance can affect the depreciation story. Replacement cost is useful for people who need to restore normal life quickly. Mechanically, the goal is to rebuild or replace without a large funding gap. This shows up when a family needing beds, clothes, and kitchen items after a covered apartment fire. That small detail changes the decision because the method fits recovery, not bargain hunting. Actual cash value may fit items you would not fully replace. The process works because some people accept depreciation if they can absorb the difference or own older property. You can see it when an owner of an old shed choosing lower cost coverage because full replacement is not necessary. This matters because valuation choice should match real needs. The claim example is simple. The hidden lever is that a stolen 10-year-old television may cost $800 to replace new but be valued at $150 under actual cash value. For example, the owner expecting a new TV and receiving a used value payment. So the useful takeaway is that expectation gaps cause frustration. Policy wording decides, not the agent's quick summary. The moving part is this. Marketing terms can sound reassuring while endorsements or schedules change valuation. A simple example is a policy declaration showing replacement cost on the building but a CV on contents. The result is that different parts of one policy can work differently. Deductibles apply separately from valuation. What changes the outcome is that after the value is determined, the deductible may still reduce payment. A realistic case is a $1,000 ACV claim with a $500 deductible leaving only $500 payable. That is why valuation and deductible are separate cuts. Before buying, ask what happens after a total loss. In real life, walk through building, contents, depreciation, proof, timing, and limits. One ordinary version is asking how a damaged sofa, roof, phone, and kitchen would each be valued. The practical lesson is that scenario questions expose hidden gaps. Replacement cost and actual cash value are not small technicalities. Under the surface, they decide whether insurance helps you buy a new replacement or gives you the depreciated value of the old thing. Think of the difference becoming visible only after a serious claim. The viewer should remember that understanding the phrase before loss protects you from shock. Replacement cost and actual cash value can create very different claim outcomes. Imagine a 5-year-old sofa destroyed in a covered fire. Replacement cost looks at what it costs to buy a similar sofa today. Actual cash value looks at the sofa's value after depreciation. The damage is the same, but the payout logic is not. This difference matters most when older belongings are involved. A laptop, television, mattress, or appliance may still be useful to you, but the insurer may treat it as partly used up under actual cash value. That can surprise people because they think in terms of replacement need, while the policy may think in terms of depreciated value. Replacement cost coverage may still require steps. Some policies first pay actual cash value, then reimburse the rest after you actually replace the item and provide receipts. That means cash flow matters. A person may need to buy the replacement before receiving the full amount. Reading the claim process matters as much as reading the coverage label. The practical takeaway is to check which valuation method applies before loss happens. Do not wait until a claim to discover that covered does not mean paid like new. Replacement cost is about rebuilding or replacing more fully. Actual cash value is about today's depreciated worth. That single difference can change the usefulness of the policy.